to wait for the little record on the top.
Okay.
Gonna show up by surprise. There you go.
There we go. We're recording. Okay. Welcome everybody to the next North Star Bad Charts podcast installment. It's me, Kevin Wadsworth. We've got Patrick Karim, and we have the great Surf with us. Richard, do you want to introduce yourself?
Yes, my name is Richard Cormier, and I'm I use standard technical analysis from Edwards McGee. I also use Stan Weinstein to understand where any market is in its longer term view. And I used cycles from Bressert. Walter Bressert was an analyst in, I believe, the 40s or 50s who used cycles. Now Bressert cycles have some similarities to Elliott Wave theory. Not entirely, but I use them in conjunction. I'm not an Elliott Wave theory specialist, but cycles and Elliott Wave both believe that investor sentiment is the key driver for forming highs and lows in any market. If investor sentiment gets too bullish, you typically are finding a top. If it's too bearish, you're typically finding a bottom. RSI and other things like that are used to kind of keep an eye on investor sentiment. A better one is the William R percentage. That's something that not many people use. That's a great tool to understand investor sentiment. There's two kinds of cycles that people see out there. There's Bressert cycles and there's Gann cycles. I know about Gann cycles. I've studied Gann, but Gann has a whole bunch of Gann numbers. 7, I think, is one of the most popular. 3 is another. 4 is another. 21 is a big Gann number. That's simply 3 7-year or 3 7 number 7s added together. So you can use 21 months, you can do 21 years, but Gann cyclists tend to try to find an echo year 7 years ago, 3 years ago, 4 years ago, 21 years ago, something like that. And then they try to pattern what's going to happen today in the market based on this echo year that happened, it could be decades ago. So for me, that's somewhat useful to understand, but I'd rather stick within the Bressert time frame and the TNA time frame and the Weinstein time methodology and stay in the current time zone, or I'm sorry, time frame, and say what is happening within price with respect to time, Bressert time, in the current framework. So that's how I focus on standard TA tools, Weinstein to tell me where that market is longer term, and then short term and long term cycles to both understand where I should buy, where I should set my stops, and potentially where I should take profits. Profits are harder with cycles because Bressert cycles measures everything low to low. So it will tell you a standard intermediate cycle will be somewhere between 5 and 6 months for most markets, but that's not guaranteed. So you really need, time is important, but the price action trumps time. There's a cycle tool in stock charts, which is useful, but cycles are, the intermediate cycle is a strong clue, but sometimes it's 5 months, sometimes it's 7 months. You can't say it's going to happen 6 months every time. But that's the best time to buy in any market, when you find that longer term intermediate cycle low. If you buy typically anything, even if it's in a bear market, according to Weinstein, you'll get 1.5 to 2 months of upside before it rolls over and start heading lower. So that's cycles in a nutshell. Any questions or thoughts?
Go on, Patrick, go.
I'm on mute. I have a question. How did you know I had a question? You saw my mouth move, but no words.
Okay, I just know you too well, Patrick.
Man, okay, this is the super tricky question, because price trumps time, and I had fun. Like, I had no preconceived notions of cycles. I tried to do cycles on PNF charts. How about that?
And
I had
PNF?
Yeah, so like point and figure, noise reduced charts, those like or the Japanese candles where the line break charts, or KG, or any of those charts where the price you only add a new column when there's enough price action to warrant a reversal. So let's say we're ranging for years, instead of seeing it linearly in the time scale, it'll just be in one column. And then if there's enough price action to warrant a reversal, then we add a new column in the other direction. So when you look at the time scale, it makes no sense. And that's just to try identify pure price action. And like, I don't know if anybody's done cycles on charts that don't have a meaningful time scale.
Yeah, I guess I would say that almost every, let's talk about Bitcoin right now. So again, Bitcoin cycle tends to be tricky. It's intermediate cycle because it is in a very, very long one now. I believe it has found a cycle low, but it was much longer than 6 months. So if you look at low to low from last September, now it was almost, what, 8 months or 9 months. And that's a long, long intermediate cycle. So let's talk about that intermediate cycle. So in an intermediate cycle, you tend to have shorter cycles. Let's take Bitcoin.
I've got it on the screen for you, Richard. I'm not sure if you can see that. It might help.
Got it. So you've got your this one right here. You see where I'm pointing? In 2017, Bitcoin hit the 20K. That was a major cycle high. It was also what I call an Elliott Wave 3 high. The move into the late 2018 low right here was an Elliott Wave 4 low and a 4-year cycle low. So Bitcoin's longest cycle that I track is a 4-year cycle low. And what Bitcoin tends to do, it tends to be very volatile, as you know. It tends to make a 4-year cycle peak in year 3 and then lose about 80% of its value as it moves into the 4-year cycle low. So what you saw is that 20K was major resistance. You moved up, then you had the COVID scare. That was an ICL and also a retest. Markets love to retest both highs and lows. That low held, and now once you got above 20K, you're moving into what I call an Elliott Wave 5. So this is a major Elliott Wave 5 up, where after that top, you should expect a major correction. The top that went to 63 or 64K was a minor Elliott Wave 3 within 5. So now you've got, out of that 4-year low, you had a high initially in mid-2019. That's your Wave 1. Your coronavirus low is your Wave 2. Your move up to 63 or 64 was Wave 3 of Elliott Wave 5. That recent low right down there was Wave 4. I am now expecting a new ICL, a new intermediate cycle starting that will lead to an Elliott Wave 5 top sometime in year 3. And then into 2020, I'm expecting a low. Then after that Wave 3 top, either later this year or early next year, into 2023 perhaps.
That ties in quite well with the arc patterns that I've kind of drawn there, doesn't it? It kind of suggests that we're going to perhaps target that darker orange shaded area later this year or early next year before descending down into what might be the
my targets go as high as 150K like you have.
Yeah.
A more reasonable target, in my opinion, based on Elliott Wave theory and its extensions of what you typically see of a Bitcoin Wave 5, I'm targeting between 80K and 120K.
Yeah, into this area.
And so
here.
I'll probably start taking some profit around 80K if my cycle and Elliott Wave analysis is correct, and gradually phase out. I'll always keep some because I could be wrong. Maybe there is no major move lower in a 4-year low, but I do plan to take those profits and then watch as the low develops and be ready to buy at the next 4-year cycle low. That's basically my approach.
which
So
could
sometime
be
in 2023, I'm expecting that 4-year low to form. And if so, let's say it goes to 100K, then an 80% drop would take you back down to 20K. Isn't that a nice number? Where your former breakout took place, and now that's your 4-year cycle low in sometime in 2023.
Yeah,
that's kind of what I'm expecting. I could be wrong, but that's my game plan. So you have basically trading is all about having a game plan and understanding what you do if you're correct in your assumptions and what you do if you're not correct, right?
That's fascinating stuff, and it's interesting. I don't know if you've looked at how the altcoins tie in with Bitcoin and how the Bitcoin dominance chart plays into this, because there's a chart here that that sort of shows how much of the market is made up of Bitcoin, and when it's dropping, Bitcoin dominance is dropping, as it did in 2017 to that peak in 2018, then in relative terms, the altcoins are outperforming. When the Bitcoin dominance increases, then Bitcoin tends to outperform. And of course, we're currently in what looks like it could be breaking. I'm assuming that green spike down is, I'm assuming that's some kind of anomaly, but we're in what looks like a bearish rising wedge here. So if we break down from that, then the ratio is breaking down, in other words. So an ever decreasing amount of the market is made up of Bitcoin, which would tend to indicate, as past history has suggested here, that the altcoins will outperform. And that's another, I suppose that's just another way of looking at the Bitcoin ratio chart, which you could.
There is. I think when you decide which so then the question is which altcoin, right?
Yeah.
So there's a lot of fundamentalists. I have subscribers and I guess contacts. One guy that follows me on my site and follows me closely on Twitter is a fellow that we have a triplex in Hermosa Beach. I live in Capitol Beach, California, in Southern California, but I used to live in Hermosa Beach, and my wife and I have a triplex that we have in a partnership with another fellow that's a rental, and he is just a Bitcoin fanatic, and he likes polka dot, I guess, because that was the inventor of Ethereum, and then he likes Theta because it's some kind of a streaming. But I don't look at that. I just look at price and how it reacts. So for me, Bitcoin dominance is useful, but I think looking at BTC versus any altcoin will show you that, at least when I look at it, Ethereum has a chance now of outperforming Bitcoin in this next leg up, in my opinion.
Well, it's literally just broken out. Actually, looking at the chart at the moment, it's broken out of what looks like a descending wedge, having bounced off a fairly significant sort of support level. So it's targeting somewhere up here using my methodology anyway. But in general terms, it's been outperforming since.
So it hasn't made a new all-time high yet. Bitcoin obviously has, but I think once it does that, if it can get above that all-time high, then it should outperform Bitcoin into this 4-year cycle high. If you look at any other altcoin, I call them shit coins. They just do not perform well. They perform well against the US dollar. Most cryptos do. But when you compare them against the king, Bitcoin, only Ethereum's chart looks promising, in my opinion. Every other altcoin is, you need to look at it against Bitcoin, in my opinion, to really understand how much you should be putting into that coin versus the king and the king's right hand, which is Ethereum.
Yeah, interesting stuff. I understand.
Have you seen how to do those charts, by the way?
Which chart? Sorry.
BTC versus Ethereum, for example.
I can. Yeah, I mean, I'll quickly share the screen if you like. But the chart that I had on screen there was the Ethereum Bitcoin chart.
Got it. You write it there. Okay.
Yeah, that's it there. So, I've got a list of altcoins here listed against Bitcoin to see how you can see the fact they're all green at the moment. So currently they're all outperforming Bitcoin quite significantly. So that Bitcoin.
But look on a 3 years. But look at it on a 3-year scale, though.
Yeah. Since sort of 2018 to 2021. So yeah.
Yeah.
I understand, Richard, you've got a couple of charts yourself that you'd quite like to show us. So do you want to?
Yeah, we talked
perhaps...
a little bit about inflation and how that might affect things like gold and Bitcoin and other assets. And I've got some charts I can share with you if you'd like.
Yeah. Okay. Yeah. Pull those up on the screen. That'd be great.
Okay. Let me open my share tray. Can you see my desktop?
Not yet.
Not yet. I'm sure it's coming at some point. Whilst you're doing, well, I was going to say whilst you're doing that, I was just going to say to Patrick, you know, when it comes to cycle analysis, I'm okay with the sort of the 4-year, 8-year cycles in the US dollar and gold, but I do find the shorter term cycles quite challenging to apply. And even those longer cycles, it's a little bit arguable whether the cycles are 15 years or 16 years, or the shorter cycles are 7 years or 8 years. It's a little bit slightly open to question exactly where you place those cycle lows.
That's the variability. That's the variability I've talked about, is that you can't say it's 6 months or 4 years exactly. In my opinion, you have to have some leeway.
Yeah, you have to use a little bit of realism.
Yep.
Yeah, the market, sometimes it just needs more time to crunch whatever it has to crunch and try. Yeah. So that's what I've noticed. You can't be super strict. There
we go. Right. We've got your chart on the screen there.
Okay, so inflation. So this is the U.S. CPI chart from this week, and you can see that inflation is increasing. You've got all items less food and energy, which is in red, and all items in blue. So currently the U.S. government is telling you all items less food and energy is tracking to about 4.5%. How you calculate all items less food and energy, why that is even worthwhile, is beyond me. And now they're saying all items, which I guess includes food and energy, is somewhere around 5.5%, if you believe their statistics. So let me show you another chart. Okay, so then if I look at here's a CPI chart that's also, so energy services, again, according to the government, 6.3, electricity, natural gas, and then all items less food and energy, that's the 4.5. So now let's go to another site where I got some stuff from Shadow Stats. That this is a basically site that I'm trying to increase the so you can see this better. Let's see. This is Shadow Stats, and basically he is calculating inflation based on how the government used to do it in the 1980s. And so what he's showing is consumer inflation is really heading towards 10%. And then this is the US CPI, which is the 4.5. So they're saying 4.5. Shadow Stats is saying, you're closing in on 10%. Now, if you look down here, here's another one that is showing it's above 10%. So this is saying this is right around 5. This is probably the 6% that the government was showing when you include everything. They're saying you're now running around 13 or 14%. I believe Shadow Stats a lot better than I believe the U.S. government. That's just me. Now, so you say, any questions on those before I go to another chart?
Yeah, I'm just curious because is the spread between those two, the Shadow Stats and the government CPI, is it augmenting, or it's just after the government recalculated its way, it just created like a distance in between each of those lines, but they've stayed, the rate of change has stayed the same? Because I've noticed markets often react not to nominal values, but more to the rate of change. So something important happens. So let's say the rate of change in the Shadow Stats, it shoots up as a rate of change, and that same rate of change shoots up in the current CPI of the government, it has pretty much the same impact on those inflation sensitive instruments and not the nominal value.
And
But
also a part of that, Pat, I think the reason that the difference seems to be increasing is because the changes in the ways that those figures are actually calculated. The shadow stats are, calculating it in the same way that it's always been calculated, whereas the government figures are, shall we say, euphemistically adjusted multiple times to take things out of that calculation and to put things into that calculation. So as time goes by, there's more and more distortion applied to the government official statistics, and the original figures carry on the way they always did.
But at the end of the day, does it matter? Because everything's reacting to, if the market's the truth, then does it really matter that shadow stats is 5% higher, the inflation rates? Or is that just something that's going to come and hit us in the behind?
Well, it matters to people on a fixed income. So a lot of retirees, one of the reasons the federal government keeps inflation rates low is they use that inflation number to calculate the increase that they're going to give Social Security retirees. And with the demographics of the United States and most Western countries, you've got fewer people coming into the workforce to support those retirees. So they want to keep the payments level and not have them increasing. So my theory on why the government keeps inflation artificially low is to not panic markets in theory, but also not to pay Social Security benefits if they don't have to. That's my theory.
So there's a huge distortion happening.
Yeah, you could say that.
Yeah, and I think also interest rates on long-term debt are headed higher. So can you see the chart I have right now?
Yeah.
So that's a 30-year T-bill. That's interest rates. You can see they hit a major low with the panic of the coronavirus. And then they've rebounded sharply and they hit the 242 level where there was significant resistance, and they've pulled back into what I call an ICL. And so you're seeing bonds rise into this. As bond prices rise, interest rates fall. I also see a potential for bonds topping here, and I'll have some bonds charts. And if bonds are topping, then interest rates should find a low here pretty soon and start heading higher. How much higher? Will they test that long multi-year downtrend line at 3%? Remains to be seen, but that's somewhere between 2.7 and 3%, I think, is reasonable for this next leg up. And in terms of longer term cycles on interest rates, you're both familiar with Martin Armstrong.
Yeah.
And I had a chart of his. He claims that interest rates move in long-term 60-year cycles, and that this goes back to the time of Hammurabi, which is basically ancient Sumeria, thousands of years before Christ. So he claims that interest rates move in 60-year cycles, and that they bottomed in the coronavirus event, and that they're headed higher. So that's his view. That's my view. How much higher remains to be seen. But if the 30-year gets to 3%, think of the government payment on the interest at that point.
Well, can I just pick you up on that, Surf? Because I was just about to say that upper dashed line that you've got there, the upper dashed red line that keeps getting tested on multiple occasions, is clearly on a downtrend and has been for decades. What that red line in my mind represents is the pain point. Every time, if this was an ordinary stock, if this was a precious metal stock, then it wouldn't really matter too much if it breaks down or if it breaks out, and the natural forces could take over. It would break out. It's a descending wedge or whatever, and prices could skyrocket up to the upside and hit 10 on your scale there, and it wouldn't matter because it's just the valuation of a mining company. But this isn't a mining company. This is the United States, 30-year Treasury note. And there's a big problem because that red dotted line, if price breaks out there and does what the technical chart is actually wanting to do, and have a bullish breakout and accelerate away to the upside, it's not just a mining company that's getting having a big payday and is doing great. This is the United States that's having to pay, larger amounts of interest on a debt mountain that is considerably larger than it was even just a few years ago. So the ability of the US to meet those repayments is, how can I put it, questionable, to put it mildly. So that red dotted line is really, and I think should be viewed by everybody, is the sort of line in the sand. That is where the pain is going to develop for the United States. If we get to that 3% level, yeah, things are going to get very interesting, particularly if we push through it. Would you agree? I mean, would you agree with that, Richard? I mean, do you think that's a reasonable sort of way of seeing it?
I do. I do think that interest rates really have no place to go but up. They've been held down for so long, and I believe, most people think the Fed controls interest rates, and they do to a certain extent, but they really don't. The market does. The market controls it. So I'm reminded of a quote by, I believe it was Roy Rogers in the 20s, in the 30s, when the stock market was crashing and bonds were crashing, and he said, "I'm more concerned about the principal than I am the interest." When bond investors say, "Wait a minute, I'm going to invest this much money for 2% return when the U.S. is approaching 30 trillion in debt, am I really getting the interest return based on the risk I'm taking?" And a lot of people will say, "Yeah, the U.S. is never going to default." And I guess I'm less sure about that. I really am less sure about that. So I think that bond prices are headed lower and interest rates are headed higher. Let me take you to some evidence on bonds. I should have done a shorter term bonds, but I'm going to show you a long-term bond, a TLT. This is like a 30-year trend. So you can see bond prices have been heading higher for 30 years. Here, I'm sorry, this is not 30 years. This is since 2003. I've got another one that's longer or shorter. I'm sorry. So it's been going up pretty steadily since 2003, and you can see that the 3-year cycle in bonds, low to low, holds pretty. Now, pretty true. So there is some variation, but if it's true, you've got a potential head and shoulders top forming. Here's your neckline. And if true, you should start to see this head test turning down and probably forming a 3-year cycle low, and maybe down near the 110 or 100 range, in my opinion. Now, let me take you to a close-up of this. I think it's this one. No, I'm sorry. Here it is, TLT close-up. So here's that close-up of that head and shoulders. You can see bond prices are approaching that downtrend line right about where my shoulder is forming. Here's that neckline. So if you break that neckline, there's not a lot of support until you get down in the 115, 110 range. Again, this is my outlook on the market. I could be wrong, but that's how I'm playing it.
And that looks on your zoomed out chart, that looks like our friend Grady would describe as an around the apex move down, which it's interesting how different technical analysts see these things through slightly different lenses, but very often it's kind of painting the same sort of picture. Head and shoulders top, around the apex move down, false breakout, all terminology to use to describe a similar series of events.
Yep. One last chart I have for you guys is the CRB.
Yeah.
So here is a 15-year CRB index that shows the breakout, and the blue arrow should be support at this point. This blue line here is meant to be support. It's breaking out, and then I've shown you the resistance level based on what I see in the chart. So basically I look for prior cycle highs. This is a prior cycle high here, and this is a prior cycle high here, and then this is basically a prior basically where it broke down. So here's your breakdown, so that also becomes resistance. Makes sense? So now this was resistance, it now should become support right here. And here's your low. CRB typically moves in a 4-year cycle, but you can see some variation in that 4-year cycle. Some of them are a little bit longer, some of them are a little bit shorter, but the CRB typically moves in a 4-year cycle, longer term. And you can see the MACD was hinting at this. Look at the low here, and look at the divergence into this last low was a much higher low. So I believe this is another indication that inflation is heading higher, and you would say, well, then gold should benefit. But something funny is going on with the gold market. Maybe we can use that as a transition point. You guys got questions at this point, or you want to pivot somewhere else?
My observation, like after deep diving this whole precious metals, everything seems to stem. They look like the Fed fund rate, the inflation rate, the CRB, those yields. Oil looks just like that. It looks like that. It's like a future roadmap for what's happening for those interest rates that want to go up, right? All these charts that look alike.
Yeah,
that's like, so if the CRB broke out above that long-term trend line, downwards trend line, it's like that's why I agree that interest rates, it's like a roadmap for interest rates that'll catch up, and they'll have to price in that inflation.
It's interesting. I've been following these commodity charts for a while, the CRB and various others, Bloomberg and so on, and they've all sort of moved up substantially over the last year or so, with various elements of those commodities outperforming at different points, whether it's been lumber or oil or copper or whatever it happens to be. They all seem to be sort of popping at different points in time. But whilst that's been going on, as you say, gold has gone down and silver's gone sideways. So it's interesting what the precious metals complex is telling us at the moment. I'm not sure if you have a gold chart there, or whether you'd like me to share mine and we can just talk about that, Richard.
Yeah, let's take it. I've got up start charts. Let me just bring up. We'll change this to weekly. We'll make sure we got the right, and then let's do 5 years. So what you can see here is, here's your long-term, your major low was back in 2015. And then you had a basing period, what I call a basing period, where you had resistance around this level for like 4 or 5 years, and you've broken out.
And that's a Stan Weinstein stage 1 basing.
Yes, that's the breakout right there.
Yeah, moving to stage 2. Yeah.
Here's your trend that you're holding on to right now. And then here's your downtrend, which you've broken out from, and you're back testing right now. So gold's kind of at a pivotal moment. It needs to find support here, but it needs to move above both the 50 moving average on the weekly and the 200 moving average. They've formed what I call a pretty important resistance line right there. Once they break through that, then you've got a chance for, if this is correct, this is the way I see this. Elliott Wave 1 up was the high. Let me go back a little further, guys. Are you okay with that?
Yeah.
Let me go back to low in 2015. So let's do 2000. Go back a little further. Let's go to 13.
Right, Kevin, this reminds me of my stock charts days there. You're on mute, Kev.
No, I messed up here. Hold on.
Yeah, everyone's got their different preferences for trading software, haven't they, Pat? But yeah, just leave it there.
Okay, so here's your breakout right here. So this is So basically, the Elliott Wave people will tell you that right there was Elliott Wave 3 right here. This top in 2011 was also a Wave 3 top in their opinion. This right here was your Wave 4 low. Wave 4. Now, what you got here is Wave 1 up. This should be Wave 5, right? Wave 1 up, Wave 2, Wave 3. This should be Wave 4. And now you should get a Wave 5 up. That should take you up to 22 or 2300 minimum. Now, that's the should, right? That's what should happen. Let me tell you, I don't know exactly what's happening in this market, but what I will tell you is I have my own suspicion that the crypto sector is a trial balloon from the central banks. That sound crazy?
There's a lot of crazy stuff. A lot of crazy stuff goes on.
So basically, and the reason I say that is, bankers' biggest fear is a run on the bank. If everything's electronic, it's pretty hard to have a run on the bank. Right? So I just, I'm kind of wondering if cryptos aren't stealing gold's thunder. And that's very, very true with the younger generation. A lot of millennials and etc. A lot of people today have no understanding of gold and silver's monetary history that goes back thousands of years, how it was always used to back the reserve currency. Well, they changed that obviously in 71 when they dropped the U.S. from the gold standard, and they've been attacking it ever since. So I think the central banks know that gold is the monetary base, but they're trying to get away from it. So to me, it could be that at some point they want to eliminate cash because they want every transaction to be tracked and taxed. That's kind of my own thinking. Now,
I think it's probably no secret the central banks are developing their own digital currencies. That's been reported quite widely in recent weeks and months. So looking ahead then with gold and silver, what would be, tell me if you disagree, of course, but I'm aware of an 8-year cycle low coming up in sort of period leading up to the next US election, which is in November 2024. And if you look back at every 8 years at the US elections, they coincide with lows in the gold market. So so that's a fact, really. So sometime leading up to that period, between, shall we say, late 2023 and the election in late 2024, my expectation is for some kind of significant low. How significant, I don't know, but I'm trying to figure, probably along with a lot of other people, do we get this move up to new all-time highs for gold ahead of the drawdown into that low, or are we witnessing already the start of that drawdown, and are we just going to break down here and track relentlessly into that low from here?
Well, I'm going to zoom in here, but this is a pretty weak Wave 5 by Elliott Wave standard. It's marginally higher, and it took a decade to get there almost. So the thinking is, in the most recent rally, look where it stopped, right at that prior high, and it's consolidating. So what we need to see here, let's do a close-up. Let's do just 2 years. And you can see right now, I use the 10 moving average as my signal for an ICL potentially forming. So here's your coronavirus low right here. You can see you came up here, and that's too early for an ICL, but you did.
You have to click on the screen. I don't think we see
Oh.
your mouse moving.
You don't. Okay, so you don't see my mouse moving.
There. Okay, now we see it. Now it's moving.
Okay.
Okay.
So basically, here's your coronavirus low. Here's your high, which is potentially a wave 3 of wave 5. Here's your wave 4. Now you should be moving into a wave 5 higher that's going to take you to 23 to 25, hopefully, which would be a reasonable wave 5 high. After any wave 5 up in Elliott Wave theory, you should expect a significant correction. You guys were referring to it. That's the 8-year cycle low that will be found in the 2024 time frame. But right now, gold, the 10 moving average is curled up. You see that? Curled up. So you're in a new intermediate cycle. But you topped near that 1900. And now you've come back down and you're below. You need to get back above and back above the 50 in order to start to move higher. So this is the next couple of weeks. The month of August is pivotal, guys. The month of August has to see gold moving through and making a higher high. So unless, the way I see markets working, markets love to retest highs. So what you have is, let's look at those cycle highs. Here was the cycle high there. Didn't get there. It didn't make it there. It made it to the previous one I showed you on the chart, the 1900, which was the previous thing. Now it's moved back down. So it needs to move above the 10-week moving average and the 50-week moving average in order to challenge that cycle high and then the next cycle high. And if you get above here, now you're going to move up towards 23 to 25. You'll get that extension because there's no resistance above here. But this is right here. It needs to move above the 50 and the 10 moving average on the weekly to challenge that next cycle high and then the one done. And if it doesn't do that in the August time frame, then this sucker's likely going to be headed lower. How low? Boy, I don't know. But you've got a market retest that failed here. So you need to get above this resistance, challenge this resistance.
And this kind of ties in with the position that we're at with the US dollar at the moment, which is poised right at a critical point on my technical chart analysis, just challenging the 93 level. And a break this month through 93 would be quite a big deal for the US dollar. But it's also, you know, from a technical point of view, poised to drop. So there's a lot of evidence to suggest the US dollar will drop from here, and that will help, of course, you know, put some wind in the sails for gold. But both charts, the US dollar and gold, and I suppose quite a number of others, important charts, silver, for example, rates, and so on, are at some fairly critical points at the moment. So, yeah, you're right. You know, this is one of those points in time where we're going to get a signal and a direction that's going to sort of determine exactly what happens over the next few months.
Yeah, I agree. The month of August for both the U.S. dollar and gold is really important to make sure that it gets the breakout. But so this month is a make or break with the U.S. dollar, and gold is a make or break in my opinion. And gold's gotta prove it, because right now it is it's in a precarious position unless it can move above. You know, if that's your trend, it's really got to move above that resistance in order to shine, in my opinion.
Yeah, that's good.
So it's got, anyway.
Good to hear. Good to hear. Sorry, Patrick, go on.
So gold, it didn't look super good. Like it closed below the 1-year moving average. Like you see right now, they're struggling. But man, when I look at the silver chart until super recently there, I said it's not responding to gold going down that much. And that's why I was keeping a hope that, or my probabilities of this resolving upwards, I'm keeping to a bullish bias, because just the way silver's been consolidating over a year, it hasn't shown, like, it hasn't dropped to like consolidate, like, you know, it's not in a severe, look at that. Yeah. it's starting to show weakness now because it's but until recently it was still hanging in there. So what's your how do you handle the evidence or the
silver in my opinion is behaving more like a commodity than a monetary metal right now. And the reason it's more bullish than gold is that in my opinion, it's responding to inflation. So that's what's going on in the silver market. And I would say I'm a slightly more bullish on silver than I am on gold right now, although both it's pivotal for both. But basically, silver also needs to get above its 10 moving average to challenge its recent high. If it can get above 30, then it may make a run to 32 or 33 or even 35 in this leg up. And much of that depends on, is this really going to be responding to inflation like copper? So that's what's going on right now with silver. In my opinion, you're basically chopping sideways, but you are below the 50-week moving average and the 10-week moving average, which you need to regain in order to move higher.
Just whilst you're there, I'll just quickly share my screen to show the platinum chart, because talking about silver and gold there, I did a platinum chart. Let me just see if I can pull that up on the screen rather than put all my emails up, which nobody wants to see. So platinum, here we go. In fact, it's on the, I think I put it on the website, if the website's actually working at the moment. It's been down earlier on today. Let's give it a chance to see if it loads up. I'm having some issues with the IT earlier on today. Okay, I'll just type it in. Probably going to be quicker. Platinum, here we go. And there we go. So that's the platinum chart. And if I just put it on the monthly view, you can see how platinum, again, it's another one of these charts that it's a very sort of pivotal moment. It's broken out, it's come back down, it's back testing, it's resting right on a crucial support line there. So again, the month of August for platinum is going to be pretty crucial. And again, it's just below one of the critical moving averages there. That's the 12-month moving average, and it's just sitting just slightly below it at the moment. So another one that looks to be at a sort of a decision point. So it's multiple.
Yes, it is,
here.
and it's also behaving again like a commodity.
Yeah.
At this point, it is at a very important support.
Yeah. Before I show any more of my emails or anything else, I just stop sharing my screen before I hit the wrong button.
Do you look at quarterly candles, like yearly candles?
I don't look at quarterly as much. I look at monthly. I look at weekly. I mostly look at weekly and daily charts. I look at shorter time frames on my live trading station, but mostly I like to stay out at the weekly and the daily to give me clues. Because again, another interesting tidbit about Bressert cycles is that longer cycles tend to dominate shorter cycles. So if you use Weinstein and you know where an asset is in the longer cycle, it will typically dictate how a shorter, even a 6-month intermediate cycle will turn out. So in theory, gold and silver, all these are in, the CRB is headed higher. Oil's probably going to take a bit of a rest here. I think that 75 is pretty significant resistance. You could see it chopping sideways to lower for a while, but longer term, I see it heading higher. So the CRB is heading higher, but the U.S. dollar is key here. I'm in a mixed camp. I'm not convinced the U.S. dollar has topped yet. It's very, very possible. But when it finds its next short-term low, which could be sometime in August, how it comes out of that low, where it finds support into that low is important, and where it tops in its next cycle after that is important. Will give us some clues about where it's headed longer term. Malcolm thinks it's headed higher. What I will tell you, if you look at presidential cycles, the U.S. dollar tends to weaken in Republican administrations. and tends to strengthen in Democratic administrations. You can look at a chart and put little boxes about when Republicans and Democrats were in office, and you can actually see that.
Yeah, I think I saw Shism do that there. He has a chart there of his US dollar and the presidential cycles there. Super fascinating stuff. Oh man.
It's an interesting thought to end on. We've been going for about an hour or so, Patrick. So I think maybe we're sort of.
Can I share my outlook on Bitcoin?
Yeah, go for it. Go for it.
So I'm going to share my site. One more thing for you guys to look at and your followers to look at is, let me share my screen one more time.
Yep.
One of my my business partner in Hermosa, where we have that rental, I was talking about inflation with him. Can you see my screen?
Not yet.
Let me see. Hold on. Allow. There we go. Okay. So if I'm on my Twitter feed right here, there's this fellow named Jesse Felder. Can you see that?
Yeah.
He's a perma bear. I'm not real big on perma bears. I think they're often wrong. But he publishes a lot on inflation. So I follow him, and he's got a lot of, almost all his tweets, not all of them, but they're about markets and they're about inflation. So he's potentially a good source. But if I go to my own feed right here on SurfCity, and I go down, let me find that Bitcoin outlook. So it's a pretty good chart, I think.
He's a perma bear on the US dollar?
He's a perma bear on inflation and stocks. Oh, obviously, the stock market's going up, so he's been wrong. Here's my longer term. So this can you see this?
Yes.
Yeah.
Okay, let me do Bitcoin. So again, here's what I was talking to. This is a pretty good chart. It shows you that's a 4-year cycle low. Here's wave 1. Are you seeing this?
Yes.
Yeah.
Okay, wave 1, wave 2 low. Now you're moving into that. This is wave 5 up, by the way. This is your wave 3 top. Wave 4 is still underway. Well, it's formed. This was back on July 22nd. So I'm expecting that if that upper support zone held, which it did, now I'm expecting the move up to that 80 to 120K. Could be 150. You could get extensions. I have some people that say it's going to go to 500,000. I don't believe that's realistic in this 4-year cycle. But Bitcoin was being accumulated during this entire period that it corrected. Yeah. You can see that here.
What's that indicator, Richard, at the bottom?
It's accumulation distribution indicator on stock charts. So here's what I like to look at. On stock charts, I like to look at a couple of things. We're back to, let's do Bitcoin right here. And you can see down on stock charts, there's this thing called accumulation distribution line. That's what you're seeing right there on that last one. A couple more to look at.
Can't see that on the screen at the moment, Richard.
You can't see that?
Your mouse hasn't moved.
There you go.
Yes, okay. Now we can see it. Yeah.
Yeah. Another one I like to watch is OBV. I believe OBV is one of the few leading indicators that you can look at in any chart. And what you like to see is OBV either leading or confirming new highs. And you can see on balance volume, again, during this downturn, moved largely sideways, didn't make a lower low. So you see here, can you see? So if I use a couple lines here, you can see this 29K held, right? But look at here. Same kind of thing. You just didn't correct much with OBV. You stayed strong. Now you have what you'd like to see here. What you'd like to see is OBV start leading. And what I mean by leading is you want to see it making new highs before price. So if you can start, this can start to move, and right, you can see can you see this? That's your next 45K. If you can get above 45K to 47 and 50, and OBV breaks above this line, you now have a leading indicator, in my opinion. In any market, you can do this, where OBV is giving you a very strong signal it's going to break higher. That's why I like OBV. I use it a lot. Don't always show it on my charts, but I'm always looking at it. Doesn't matter the market.
That's my new rabbit hole, Kevin. I have 3 indicators there to deep dive.
That's the next few hours for Patrick is looking at the OBV indicator and back testing it in historical examples. I'll speak to you tomorrow, Patrick, when you come out the other side.
Now look at it for. Can you see it for gold now?
Not bad though. It looks good, right?
Okay, so gold. Now here's what you're looking at. Here's what you're looking at with gold. This is actually, I hadn't looked at this in a while. So here's your resistance at the 1900. Now look at OBV. You've already made.
You have to scroll down.
You just need to scroll down a little bit. I think your cursor hasn't moved it.
You see it?
No, not yet.
You can't see my screen?
I think there's you know what? I think there's just a small lag, Kevin. Sometimes the screen shared freezes a little bit.
We can see your screen, but it's just not scrolled down yet.
You just put the red line, and now nothing's happening.
On OBV, you see it though?
No.
Or no, you don't see it. Okay.
How
about now?
There you go. Yes.
Okay. So what you can see is price is still below the 10 moving average and the 50 moving average on the weekly, but OBV has made a slightly new high from that prior high. So that's a positive signal for me that gold should be heading higher.
Okay, I'm all in. I just bought some more gold futures, Kevin.
Okay, guys, any other questions or thoughts for me?
Well, can you come back, Richard? Because man, I have so many more questions, but we could this was like a good intro for people to know you, to follow you, to subscribe to your service, and then maybe have another session. I don't know when there, but I just love these brainstorm technical sessions, especially on stuff that I'm not very familiar with there. So,
okay, one last thing I'll leave you on cycle. So, if most assets have a 6-month intermediate cycle, then those intermediate cycles are broken down into shorter term trading or daily cycles, and those vary by asset. So if you look at stocks, typically between every 36 and 46 days, you'll form a short term daily or trading cycle low. For Bitcoin, it's 56 to 66 days for the trading cycle, so it's longer. For gold, it's less. It's 24 to 28 days typically. Now, they can be longer, and they are longer, and they can be shorter, and they are shorter. But in general, what you need to understand is that within that 6-month cycle, various assets are shorter and longer. TLT, for example, bonds are around 20 days, low to low. So you have to understand and calibrate cycles for different assets, both shorter and longer term. The intermediate cycle is pretty solid across most assets. It does vary, but the shorter cycles vary more by asset. So that's just kind of a nice closing note.
Well, that's it's absolutely, it's been fantastic to sort of run through all of that with you. I don't know what Patrick thinks, but it's been, after all these years of following you on Twitter and back in the gold tent days, I have to say, by the way, that your chart analysis, along with Rambus and a few others, sort of inspired me to get into all of this in the first place. So thank you for that, I suppose.
I appreciate it, guys. I appreciate you including me. I've enjoyed it. You guys have a great week, and we'll be back in touch.
Yeah, that's fantastic. Thank you. Thanks, Richard.
I appreciate your time. Ciao, man.
So you guys will send out links, and we can all promote this?
Yes, of course.